Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.
Hello and welcome to Nirmal, ladies and gentlemen. I'm Hiral Dadia. We have with us Radhika Rao, Economist, Senior Vice President, DBS Bank, joining in. Welcome to the show, Radhika. Pleasure to speak to you as well after a really long time, and I hope you're staying safe. My first question coming to you overall is, how do you see the impact of COVID playing out in the region right now on a broader basis?
Thanks, Hiral. Pleasure to be here. Uh, I think the impact we are really, all the countries are facing the same storm, but I don't think we're all in the same boat. So to that extent, I think the impact is differing very widely across the region as well, and if you look at it globally as well. I would generally break it down into three phases. The first phase was when the infection took place, the first breakout, and in some parts of Southeast Asia, it was as early as late Jan to early February. So from then on, it spread to other parts of the region. So Feb and March was really a washout. The authorities were really caught scrambling. You've got the currencies or the stock markets that really corrected very sharply, and that was really acute first bout of correction. By April, May, we did see some kind of stabilization. Then on, moving to the second phase, which is where we are seeing a second wave, third wave in some countries, and countries like India, where we have not got the main infection curve under control. There are multiple waves feeding into it. So that's where we are right now, where you can't help but we have to reopen the economy. Livelihoods really do matter, and hence you're going to see more localized lockdowns. You won't see the markets really go erratic because they have a sense of confidence as well that things are under control. But day-to-day basis, it could vary. And the third stage would be when we have the vaccine, and I think that will be certainly the most important component for many countries to make sure that we go back to normalcy in any manner.
Right. So, taking this into consideration, if you talk about India as a whole right now, we are seeing somewhat of green shoots that are emerging in various sectors of the economy. Do you think this is something which is going to be sustainable, or do you think it's just a mechanical rebound that we're seeing at the moment?
In the US, talking about an October surprise before the elections, I think for India it was a September surprise. There's a good bunch of data which is turning around. In fact, it has been, I think, from late August onwards, we've seen numbers improve. Into September, you've seen PMI, manufacturing PMI look good. You've got exports, GST collections, e-bills, the e-bills. You can take your pick. So certainly a good bunch of data looking good. And I think that is a function of more and more of the economy opening up, right? So we have seen 5 months of unlocking now, and each
Mm.
unlocking is about opening up another new avenue in terms of either, and the latest one that is Unlock 5.0 has been about more social activities, which might involve some kind of, closer contact based theaters and rest in room dining, and all of that. So certainly that is showing up in the numbers. I think for this, we would necessarily think that it is going to be on pace, but it's going to be two-speed recovery. First, to mean that supply will certainly catch up much faster than consumption. So
Mm.
people are getting back to workplaces, either they're home-based or still going back to work. But and the employment data from CMI is telling you that unemployment rate is falling, but the kind of employment that is being generated may not
Mm.
be at the same returns as it was before COVID. So it's going to be supply catching up faster than demand, and in between, within supply, I think manufacturing will be much doing much better as compared to say services, because if you see PMI services, while
Mm.
manufacturing PMI has really spread fast, services PMI has not. Even entertainment, or you say airlines is working at about 30-40%
Mm.
capacity. So it is not really everyone headed in the same direction. It is a bit uneven and two speed at this point. Nonetheless, I think we are looking at sequential improvement across different sectors.
Right. So, I mean, that's about where India is concerned. If you have to look at different Asian countries at the moment, Radhika, uh, how are they faring in the midst of this crisis, according to you?
I really think it's boiling down to three main points. First is without fail the pandemic management. Um,
Mm,
in this regard, what we have seen is that if you see the Asian region, North Asia is doing better than South and Southeast Asia. For instance,
mm,
when I say North Asia, you would say countries like Taiwan, South Korea, you would say China, you would say Hong Kong. These countries, in some forms, did face a second or a third wave, but broadly, the pandemic management has been such that they have been able to bring it back under control, and mobility reports are looking much better there, almost near normalcy, barring travel. Tourism has not taken off, but everything
mm,
else internally is coming back towards normalcy. And then we have Southeast Asia, South and Southeast Asia, where between countries there is a difference in how fast they've been able to bring the curve under control. Uh, the second factor being how exposed are you to what's happening outside. If you are a very trade dependent country and if you are a very tourism dependent country, the
mm,
recovery is going to be much slower. Let me take the example of Thailand in this region. Domestically, the pandemic was very, very well managed. I think totally they have less than 4,000, 4,500 cases. But it's a very tourism dependent economy. And since international borders have not opened up as yet, you're not going to see that recovery take place. And the third would be, in terms of trade, some sectors are doing well. For India, I think pharma is helping. In other countries which are more electronic,
mm.
oriented towards electronic exports, they are doing well. So it's certainly a very differentiated improvement. But the ones that have got pandemic under control, who have been are a bit more export focused, are these countries are the ones that have fared better, and then we see that distinction more clearly between North Asia and Southeast Asia.
Right, so Radhika, taking this study into consideration, do you think any model that India should be adopting at this current juncture, taking lessons from any of the other countries?
I think we can adopt some of the lessons, not all. I think we are in a unique position because some of our own demographics, some of our own
Mm-hmm.
population density, are these things are certainly unique to us. So it does take a while, but I think the initial response that was so much of the hurt that you're seeing in growth, what was a necessary evil to mean that that shutdown was necessary to try and break that transmission. But nonetheless, I think, like I mentioned, we are now realizing that there is very little you can do by shutting, everything and everyone down. What we can do is more localized, try and contain the problem, but reopen nonetheless, because we know that while going into this 2020, the economic immunity was already quite low. So we can't afford to put the economy, closed for too long. So the unlocking process, I think, is right, but the only price that we got to pay is that the cases will continue to go up. In fact, from since the unlocking process has begun, 90% of the caseload has been in this time period, right? Not when the shutdown was happening. So right now you're seeing the cases go up as well. So to the long and short of it, the point is that yeah, I think we will have to. The economy will learn to live with the pandemic. I think there will be no normalcy, so to speak, so soon. I think it will be a new normal where if the hopefully the health infrastructure is able to take in the pressure, but nonetheless there's going to be no rolling back in lockdowns. You would see localized micro containment zones, but not a full scale lockdown.
Right. So taking this into consideration now, if you have to talk about FY 21 and 22, what is your growth expectation and outlook for India? Because you already seen a negative GDP print right now. The anticipation is probably we could continue with a negative GDP print, at least in terms of a calendar year 2020 is concerned, and probably in FY 22, the first quarter could see a good bounce back where we could still be in, say, lower single digits. What's the sense that you pick up on that front?
So across the board, regionally as well as in India's case, we have seen that the bulk of the pain was felt in the second quarter. That is first quarter for our fiscal year, and that in our case, what has happened is put us in a really weak starting point. So in fact, 24% contraction was the sharpest,
Mm-hmm.
not only among the regional countries but also among many of the major economies. So that itself brings, arithmetically brings the full year GDP down considerably. And thereafter, we have to see sequentially, we do think there'll be an improvement. So second quarter GDP, that is second quarter fiscal year, we think there'll be about 12 to 13% contraction. And thereafter, we will get less and less negative because the economy is indeed opening up. But nonetheless, I think it will be hard to move away from a double-digit contraction this year. So our estimate is about 10.5% for the entire fiscal year. For 2020, it's about 9%. And optically, FY22 is going to look very good. We're between 7.5%, 8%. So I think the clearer picture will emerge in FY23 when you will have done with that zigzag motion, and you will get also a clear picture of how much the pandemic has been addressed. And we're quite hopeful that at least by mid of early part of next year or mid of next year, not only a vaccine is available for mass consumption. That will be very, very important to put all the economies, and India especially, onto a more durable recovery.
Right. So the quantum of output that we've lost, and probably we would be losing further as well in the coming couple of months, is something we need to watch out for. However, when are you expecting normalcy to return?
So I think I will go back to that two-speed recovery that we spoke about. Right? So supply doing better than demand, and you would see manufacturing doing better than services. So these 2 years of growth is exact that we're going to face. So fiscal 21 is going to be very weak. Fiscal 22 is optically going to look better. Nonetheless, I don't think in these 2 years we would have really made up for all the lost output. Right? So manufacturing we can. Today we don't make a car. 2 months down the line we do. But what we didn't eat today, or the trip down to the entertainment park and we didn't, 2 months later, even if we do, it's not going to be making up for lost output. So some part of output is certainly lost. So if you were to ask me how do we make up for that loss, I think the trend line, so to speak, the growth line has certainly shifted right because of these 2 years or particularly FY21. So we are on a different growth path, which is a bit lower than where we were pre-pandemic. Nonetheless, we hope that we would go back to a more durable 4 to 5% growth rate in about 2 years' time after this FY22 is done, and which will take us back to where we were pre-COVID. So a return back to where we were pre-COVID, I don't think is going to be possible, particularly if we can't do a double-digit growth in the next 3-4 years.
Right. And Radhika, so far as well during the lockdown, you have the center as well as the central bank that have taken measures and steps to limit the extent of deceleration during the lockdown. According to you, have these measures really worked?
It's been at least the first phase was very well coordinated. I mean, you had RBI who came in, not only did they work on cost of borrowings, but they also made sure there was, that the pandemic didn't become a financial sector crisis. And I think that they played a very important role in that. At the same time, you had the government who made sure that sustenance or survival kind of spending was happening. But we should remember that, we often mistake the government spending at this stage. Again, not only in India, I think it's worldwide. We tend to think it's a stimulus, but I don't think it's really a stimulus because it is almost to keep the person or the company running on the spot, right? To mean that you're just maintaining the output that was there prior to the COVID or prior to the pandemic. It is not about lifting yourself up from where you are at this point. So that, by definition, so the impact of this kind of spending will not be enough to lift growth. I think the attempt is to keep growth where it was. And that too, I think, will not be very, you won't see that if 100 rupees is being spent, you won't see the full impact because people are still earning less than what they did back in Jan or Feb. Companies have a cash flow problem. We just have to make sure that they don't become, out of hits, or their solvency doesn't become a problem because of that. So that kind of push is going to continue from the government. So as far as the central bank is concerned, I think they have done the first part of the work. Now on, it is upon the fiscal policy. And here too, I think we have done the survival bit. The next leg would be a lot more piecemeal where it is required. They would step in, things like promoting domestic tourism. That's something we have seen in the region as well. Till the borders open, and you also got possibly an employment scheme, which is for particularly for urban poor. Those kind of piecemeal measures might be in place in the next 3 to 6 months. But I think what happened during the pandemic, I think was timely for that part. But we would certainly need more to pull the economy out of the condition we are in.
Right. So that's what the government probably needs to do as well, further with regards to reviving the economy is concerned. So is there any expectation of another stimulus package that could be in the offing probably in the next 2 to 3 months?
So we are hopeful that the government. I mean, in passing remarks, we have seen them alluding to it, or some other government officials, not necessarily the MOF, but other officials also alluding to it. So there could be something in the offing, but I think we need to be also cognizant of the fact that the fiscal room, as it stands, the fiscal deficits are going to be much larger than what was budgeted in February. We are looking at our own forecast is that it's going to more than double. So center, at least it's going to be about 7.5, 7.8%. So it's going to be significantly higher without really factoring in that additional spending because revenues are much weaker. So I would think yes, to answer your question, we do see a room, but something in the room of say 0.5 or 0.8% of GDP in terms of quantum, but not really a huge extent of pump priming. I think the push is certainly to do more medium-term reforms, which you've seen in the agriculture and the labor place more recently.
Right. And to do this as well, another question that comes in for the government is with regards to where the borrowings are concerned. Now, majority of what was planned for the full year has already been borrowed in the first half. Do you think that the government will increase the second half borrowing? Uh, any expectation on that front?
What when the borrowing schedule for the second half was announced, I think it was quite prudent to just maintain, what totals up to 12 trillion for the year. Indeed, as much as us, I think the government even better knows the ins and outs. They do know that there is a significant amount of uncertainty over how much of revenues we'll be able to garner in the remaining. We are almost just past the halfway mark for the year. If I look at the run rate for April to August, what you see is that tax revenues are only about 20% of full year target, but even weaker are divestment. Now, if I remember the budget back in February, we could recollect that there was a lot of emphasis on that divestment proceeds that will bring in a big boost to revenues, right? So right now the current rate is less than about, I think, 5% for the year. So there is a gaping revenue gap. So right now I think the central bank and the government prudently decided to hold the borrowings as it is, but certainly, and this schedule is going to end in somewhere in I think late Jan. That means that by then I think there will be greater clarity on the kind of revenues we'll be able to garner, and then perhaps we could see a 1.5 to 2 trillion at least additional borrowings is what we anticipate. So that would mean about 14 trillion.
Right. And then what would your view be with regards to where, deficit monetization is concerned? Is there any regional perspective that you would want to give on this? Because that's something that probably the government would have to consider sooner or later.
Certainly, and that is something that we used to consider quite a Western concept has hit home, hit the Asian shores this year. In fact, few of the regional countries have already implemented it in various forms. And I could give you the example of Indonesia, which has not only been buying government bonds in the secondary market, they've been also doing it in the private placement space and also an outright burden sharing with the government. So that is certainly so what we did see is that among investors, the initial reaction to deficit monetization is that it's not a bad idea. It's a tolerable thing, particularly if the country has a good fiscal record. And this pandemic, you know it as well as me that debt and deficit levels are going to really balloon. But the problem is that you're not going to just have a deficit problem this year, right? You're going to have a deficit problem next year as well because the economies are still healing. So what that means is that this deficit monetization will not be a one-time temporary phenomena. In fact, the central banks will have to continue to support this year, perhaps the next 1 or 2 years as well. So it's a tap that, once it's open, it's hard to close. And taking it to India's context, and I think that is where the central bank's worries lie as well, I would assume, because we were in the 80s, it was part of the cost to consider deficit monetization. Then we have FRB and bring in that better framework. But to go back down that path, I would think because of the economic repercussions one can have, inflation, rupee depreciation, particularly for countries who have twin deficits, that becomes a bigger problem. So I would think that's where the worry lies. And to us, we think OMOs will be still the preferred route. If the domestic buyers, particularly banks and some of insurance companies, are not able to absorb the supply, only then I think the central bank will go down the debt monetization path. So I don't think it's a given. So it's more like a last resort option.
Right. So Radhika, is the RBI needed to actually develop a clearer strategy as to what to do from here on, or do you think enough is done? Because at one end, they're legally bound to an inflation target. Yet at this juncture, probably there is a strong argument to look past the current spurt in inflation and test the limits of both conventional as well as the unconventional monetary policy. What would your view be on this?
I think they've done. I think the RBI has done a fair amount of heavy lifting. This year, in fact, their rate cutting cycle started last year, and this year I think was expedited because of the pandemic. So cumulatively, the rates have really been cut quite sharply, considering the inflation dynamics. So we think the conventional path is nearly almost done. I mean, we don't see too much room for rate cuts from here. But the unconventional is where the bulk of the work still lies, meaning that bond markets is something that the central bank has really focused on now, after taking care of the moratorium, right? So moratorium was extended to financial institutions and to borrowers. We have a recast now, so that has been addressed partly. So now we are on to debt markets where borrowing costs have to be kept low, even though we're going to see record amount of borrowing or issuance being done. So this is where I think we would see much bulk of the action for the next 3 to 6 months. And like I shared earlier, I don't think it can be taken for granted that we will go down the debt monetization route. I think it will still be more open market operations. But yes, the markets would look for more clarity. So these are assumptions that we're all pricing in. But one is hopeful that there will be very clear communication on the fact that yes, we will be here to backstop the bond markets and make sure that all that transmission that has happened does not reverse.
Right. So as you mentioned about the bond markets as well, taking all of these assumptions into consideration with regards to growth, inflation, with what the RBI could do in terms of interventions, where do you see the rupee heading from from here on? And in turn, what's your view with regards to bond deals, taking the next 3 to 6 months into perspective?
Sure. So let me take the rupee first. So the rupee did, we had the central bank, apart from the mainstream rate action, was also in kind of a balance beam. They were managing the currency. They also need to manage the bond yields. At the same time, you had excessive dollar flows in the system because of the balance of payments surplus. So among these, I think rupee is where they were, watching it very closely. Right now, the bank market assumes that they've gotten off. They can tolerate a bit of rupee appreciation. But for our in-house assumption is that on the broader scale, on the dollar view, we are of the view that dollar has already hit bottom and it's going to continue edging higher. In fact, into the elections, we have seen in the past two cycles, election cycles, where the incumbent faces risks of there could be a change in seat. That kind of elections usually sees the dollar strengthening going into that election, and we see that happening right now as well. And that's why we don't think the market assumption that rupee is going to appreciate strongly is going to hold out. So we are personally of the view that dollar rupee is going to edge back towards the 74.5, 75 kind of levels. Going to your bond yields, we do see room for yields to stay below 6%. Again, not by much, up to about 5.8% sorts. And this is hinging on the fact that that communication that we spoke about earlier happens, where we get a clearer idea that the central bank is going to be standing by. So we do think it can go down a bit from current levels. This is on the 10-year, but not by much. So thereon we have it going back to 6.1, 6.2 kind of level
Right.
over
So
the
what
next
would your
6 to 8 months.
Right. So, Radhika, what would your outlook be with regards to where inflation is concerned? Because the RPI has constantly hinted that inflation is going to remain at elevated levels.
Yeah, unfortunately, I mean, this is a time when, again, I'm providing a more regional outlook. We've seen some countries in midst of deflation, or disinflation, where the prices have been negative for a good 3 to 6 months now. But ours is the reverse, where because of supply side and idiosyncratic, I mean, it's partly the pandemic, partly inbuilt idiosyncrasies, particularly through the taxation, and gold and all of these, which have really added to that inflationary stickiness. So I would think again, we haven't had the new committee as yet. We are hopeful that the new
Mm.
committee will be in place, and the October meeting, which got pushed, those dates will be named soon. But nonetheless, the inflation trajectory is that it will, even in September, we think it will stay as high as 6.5% plus, and then slowly go down. But then too, I don't think it's a huge correction down because of base effects. You might see going down to below 5%, which means by extension that the central bank doesn't might not have too much room to cut rates further from where we are at this point.
Right. And Radhika, in spite of the quantum of rate cuts that we've already seen so far, we're not really seeing an impact with regards to where credit growth is concerned. Uh, Number one, with this, what's your outlook on the credit growth going ahead, and where are interest rates headed according to you, taking the demand supply into consideration as well?
Um, so, credit growth in this environment is certainly difficult to revive, uh,
Mm.
essentially because funding is a supply and a demand issue. So certainly there seems
Correct.
to be supply, or at least the banks and central banks seem to push towards making that there is ample supply available at attractive cost. But nonetheless, demand might also not be available that easily because there is, uh, like I mentioned, more operational issues rather than building special capex and going out and buying that other company that the companies have been eyeing, businesses have been eyeing for a while. So at this point, and the banks on their end, certainly liquidity is available, but they're going to be more due diligence because of that strain that is yet to be seen, which will, I think, be seen only 2 years hence. We are not very hopeful that the credit growth will really pick up
Mm.
this year, particularly. That means the credit to deposit ratio will continue to edge down. So we are, if I were to give you an estimate, we are at about 3.5 to 4%,
Mm.
where the growth rate will be towards the end of the year, and hoping that once we have uh, the recovery, we get better visibility on that, that it would go back up, as will base effects as well for credit growth. And coming back to your rates question, like I mentioned earlier, we don't think that we have one 25 basis point cut penciled in for the March quarter, but I think the odds are quite low. So I would think that more or less rates are might be where they are at this point.
Right. And very lastly, Radhika, then if you have to look at India, how are investors comparing India in the emerging market pack if you have to look at FIs or probably even your clients right now? How are they actually looking at India?
So I think there are various. I think India is still a very attractive proposition. Now, particularly, we have seen flows coming in. We have seen FDI, of course, there's particular names attracting more FDI in the past
Mm.
3 months. Not wholesale, because again, companies are really reworking their math on where to go and
Mm.
how much to invest. But we do see that potential FDI interest still very much being there. And again, we have seen the PLI being extended, first of all, to the telecom players, and I think or mobile phone players. We do think that might be extended to other sectors as well. That means that favorable terms, along with lower tax rates, will help attract some of the FDI. And in terms of FII, I think the bulk of the interest right now is in the equity space. So that's where
Mm.
we have a lot of inflows. Debt as are the domestic investors. They're also looking at, how is the fiscal picture going to pan out, and how is it going to be, how will that be managed in terms of absorption. So, in fact, in September, I think the debt inflows have reversed. That means the FIIs have started to come back again. But I think that kind of clarity, if given, would certainly see more inflows than, say, in the March, April.
Absolutely, and I think that's something all of us need to watch out for as well, because clearly, what's happening is everyone's dependent on rural India to get back growth, and whether the downtick that we are seeing with regards to urban India, whether rural India will be able to support that or not, is something we need to watch out for. But Radhika, any thoughts on that front? Whether the kind of dependence right now that we're talking about, where rural India will be the driving factor to revive the economy, do you think that's something which is going to be sustainable? Because remittances from urban to rural have still gone down right now.
Certainly, the rural story is something I think it's been milked for quite some time, particularly in the past few months. So rural, again, we need to break down farm and non-farm, with 70% of output happening in the non-farm sector. So that is the part that needs to really fare well. I think agricultural sector certainly is doing much better. In fact, it was doing better even before the pandemic. And going into it, monsoons have been, we have got now two back-to-back above normal monsoons. Reservoirs reservoir levels are better than it was last year. That means the Rabi crop is also going to have sufficient water supply. So there is a lot more food grain availability. In fact, the record forecast has been made. So farm sector particularly, I think, is output-wise is doing much better. But the non-farm has heavy linkages to the urban sector in terms of construction, in terms of 45% of your MSMEs are in the rural sector, which also and wages though are doing better than farm, but are not as good as urban. And like you rightly mentioned, the remittances perspective as well. So overall, I would think yes, the rural sector indicators that gauge rural sector are doing better, but I don't think they will be sufficient to really pull the economy out of the kind of correction we are in right now. But it will certainly be somewhat of an offset, particularly. So I think we really have to wait for the services sector, which is the major contributor to growth, to fare strongly to where we are at this point, to make that move the needle for growth.
Absolutely. I think now when the economy is starting to opening up, especially on the hospitality services front, so Q3 is something probably which could start giving us an idea as well of how supportive or revival is going to be. So thank you, Radhika, so much for joining us on the show. It was a pleasure to have you. Great insights that we've picked up, and I hope you enjoyed the discussion as well. Stay safe, and we will see you back soon again.
Thank you, Hiral. Good to be here.